Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, March 13th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here, and I'll be your host for the next 30 minutes or so as we take a look at the action from yesterday and look at pre-market action today and take a look at where the market may go. I mean, I remain bullish. Just want to be really upfront with that long term. But there are a number of signals. I mean, they're starting to build in terms of possibly seeing a little bit of downside action here. Secular bull market, it's so difficult to try and pinpoint a top, even just a short-term top. And of course, secular bull markets tend to be very resilient and seem to go up no matter what, frustrating a lot of folks who are either trying to wait on a pullback or who've been trying to short, believing the market can't go any higher because it's overbought. And all of that makes for a really difficult market for a lot of traders, myself included. I mean, you just, at some point, it's been quite a while now, probably 4.5 months that we've seen this rally just it won't stop. But later in the show, I'm going to give you several charts that'll at least make you scratch your head a little bit as we look out into the future. And I'm not talking about, I'm not even talking about intermediate term. I'm just talking about short term, maybe the next 1 to 3 weeks, just things that maybe keep me up at night a little bit. And so I want to go over that a little bit later in the show, just keeping it real. I'm bullish, but as my secondary indicators begin to build and show more and more bearish possibilities, I at least recognize the short-term issues that the market continues to deal with. So we're going to go over that later in the show. But let's go ahead and get started today and take a look at what happened first on Tuesday. So we had the Dow Jones Industrial Average finish up 0.6%, up 235 points. We've been holding that rising 20-day moving average. We're back above it comfortably. Everything looks great. We're going sideways. The PPO getting working its way back toward the center line. All of that's good. I think the Dow actually looks pretty good. It hasn't had the run recently that some of the other indices have had, and as a result, I think this one probably would be spared more if, in fact, we do see some selling. As you can see, the S&P 500 yesterday, however, made a new all-time closing high. And I don't like to get defensive or get even a little bit bearish when we're making all-time highs, because I know what secular bull markets do, and they keep rising. But it comes down to risk. At some point, just like when the market was going down back in June of 2022, when I called a market bottom, we were already down 20, at that point, probably 22% or something like that. And it was getting to the point where it was too risky to stay on the short side. It wasn't that the market couldn't go lower, but I had a lot of signals starting to turn bullish. We'd already gone down a lot. And if you knew the history of bear markets, the majority of them ended with, price action that had been down 20-25% or maybe a little bit more. There haven't been too many in my lifetime that have gone deeper than that. So part of it is just perspective. And now we're here at the top, and you can see even on the S&P 500 as it keeps churning and moves out to another new high. Yesterday's volume was so-so. Wasn't anything to write home about. The PPO continues to drift lower and lower, even though prices keep trying to push higher. That's a little bit different than what we're seeing on the Dow. The Dow's almost already back to the zero line on the PPO, meaning that a lot of the momentum issues are starting to fade away. Whereas the S&P 500, as we keep going higher, seems like the momentum issues are building a little bit. Not awful, just not great. NASDAQ 100, very similar price action, just like the S&P going up. We didn't close at a new all-time high yesterday on the NASDAQ 100, but we did bounce off the 20-day moving average again. And if you look back since October, this has been, or late October, this has been the area where we've seen buyers step back in on the NASDAQ right at that 20-day moving average. but we just keep drifting lower and lower on this PPO, making me think that we're probably going to have one episode of selling. Just kind of unwind what's left of the slowing momentum issues, maybe get a 50-day test. That combination would then take care of the negative divergences in play. We look out to mid caps and small caps. Quite honestly, I think they look more bullish because while the S&P, the Dow, the NASDAQ were all going higher into the new year and breaking out to new highs, first couple months of the year, mid caps and small caps had topped at the end of December and went through a period of consolidation, and their PPOs already came down and are starting to turn back up. So here you're seeing, I think, the effect of the rotation that we've had, where momentum is slowing in some of the areas where we have the larger caps, and we're seeing momentum picking up in areas and technicals looking better in areas where maybe that money is rotating to the small and mid caps. And we're going to continue to watch to see if that continues to happen. I believe it will. I mean, the mid caps in particular, looking very strong. The AD lines barely, not even budging back to the downside. Even when we do see a little bit of downside action, AD line setting a new high. So it's telling me the money is rotating and that you've got plenty of buyers still in that mid cap area. Moving over to the transports, here's one I talked about yesterday, just sideways action. I don't really have any other word, just trendless. Transports are just doing nothing at this point. They're worth watching. Obviously, a breakout in transports would be incredibly bullish for the Dow and the S&P 500, but we haven't seen it yet. The good news is we haven't seen a breakdown either. So we've got an uptrend. We've got sideways consolidation. I believe in time this breaks out to the upside, but might have to churn a little bit more here in March before we get there. Moving on to the sector performance. Yesterday was kind of like a blast from the past. Technology leading, communication services second, discretionary third. These three groups have been lagging for the last month, and I'll show you a chart later that you can easily see that on. But for at least for a day, we came back. Now, is it going to be strong enough for all three of these to forge to new highs? Well, not yet. We did have the XLC breakout and close above 80, so it is right on the cusp. Technology's been sitting in this little bull flag for the last couple weeks, really since March began, just simply going sideways and consolidating over the 20-day moving average. So a breakout there would be nice and welcome. Discretionary is a little weaker than those two, but we're still down around the 20-day moving average, still in an uptrend. So I don't really see a whole lot of bearishness on the chart. And when I talk about maybe some upcoming, maybe an upcoming sell-off or bearishness, I'm not talking about much. I'm going to say, if we went down maybe 3-4%, that would be maybe 5, that range. I mean, that's half of a correction. I would welcome that. I think that would be really healthy for the market before we move into the second quarter. But whether or not we see it, I don't know. We need something to kind of, there needs to be some kind of a catalyst or something to get this selling started. And I don't know what that is, because yesterday we had the February CPI come out. Core CPI was higher than expected, 0.4% versus the expected 0.3%. We saw a little bit of selling in the morning. The market came right back, finished near or on its highs at the end of the day. So if inflation's not doing it, what is going to do it? And that's the part I struggle with, because I just don't know if it's not inflation. What is it? Maybe it's interest rates. Rates are up again this morning. We're going to talk about that in just a second, so I'll wait until I get to that. But then moving on to the industry groups. Look at the groups leading. The three best groups yesterday all were in the technology sector. We had semiconductors. Shocker. Up 4%, 3.9%. Another big day on the semis. However, remember, I believe it was late last week, or was it Monday? I don't know. But we had the big reversal on the semiconductors, where we had gapped up well above 16,000, sold off all day. We saw NVIDIA print and nasty, bearish engulfing candle. We saw a lot of reversals in the semiconductor area. We haven't gotten back through those levels. So yesterday was nice, but that doesn't mean that we're, clear and going to take off again. Maybe we do, but I think you still have to be a little cautious here because that bearish engulfing candle with some of these other warning signals could be starting. Maybe it's the A was the drop there with the bearish engulfing candle. Maybe the B is this little rally here over last couple of days, and then maybe we get a C that takes us down, maybe down to the 20-day on semiconductors, and perhaps gasp a move down below the 20-day, maybe even to the 50-day. I mean, we haven't really seen that in the last 4.5 months, but all of this is certainly possible in this month. And again, I'm going to give you some charts later in the show that at least tell you why I'm a little bit more concerned. Am I worried about the bull market? Listen, don't misunderstand what I'm saying. I am not at all bearish about the balance of 2024. I'm a little cautious about the balance of March 2024. I just think this is a time, where it's a quiet time. Earnings aren't really, we're not going to get earnings season to kick off for over a month. And this is the time of the calendar month within a calendar quarter where we tend to struggle. So it's just, again, a number of different things that I'll talk about in a bit. Software, big day yesterday, gaining more than 2.5%, still in an uptrend. This one looks a little bit better. Look at the semiconductors and how stretched we are on the PPO. And if you want to really see stretch, look at the weekly or the monthly, especially that weekly chart where we've just been going up, up, up every week. Very stretched there. Software, though, we topped back probably a month ago, and we had been struggling, went back to the 50-day moving average where we've had multiple tests since late October. And that's where we bounced from. And that's what we did yesterday. We bounced off of that. Again, is this the start of another move or, to the upside, or is it just more consolidation? We don't know. I would probably argue with the latter. But if we get a breakout, it's hard to argue with breakouts in secular bull markets. And that's why I think it's going to be pretty big to watch the S&P today after breaking out yesterday. Does it continue to push to the upside? Is it those value is it the value stocks that are continuing to lead the charge to the upside? Because that's what happened yesterday. That's what happened prior to yesterday. And that's what's really been happening over the last month or so. So that's something to keep an eye on. Finally, computer services. Another area in technology has been uptrending, having a big, big run to the upside. IBM is part of this group. IBM's looked really nice. Anyway, this group had a big day yesterday, rising about 2.4%, trying to break out as well. So even though technology is kind of taking a back seat, or at least up until yesterday, it was taking a back seat, these groups are not really selling off. They've just more been consolidating some of the recent gains. So nothing really looks bearish from a longer term perspective. We're not seeing breakdowns. That's what you need as confirmation for an extended move to the downside. We're seeing none of that. In fact, if anything, we're seeing more and more areas of the market participating in this bull market, which is bullish for the longer term and for the intermediate term. Again, all I'm talking about is right here in the here and now, the next week, maybe as much as 3 weeks, maybe toward the end of March, early April, 2.5 weeks. But that would probably be about tops. I really think the next 10 days are probably the area of time, the time period that we need to be watching. All right, 10-year treasury yield. So not really anything coming out in terms of economic news today. But you can see, let me get an update. Right now, we're at 418. Remember, just a few days ago, we were back down to around 404, 405. We had fallen beneath both moving averages. It looked like, okay, yield's rolling over. Not so fast. While the stock market yesterday reacted pretty bullishly to what I thought was not a great CPI number, the bond market took a different approach. And you saw that yield going up all day, which means there were sellers in the bond market. So, sellers in the bond market sending that yield higher makes me a little nervous, especially if we get back up above these moving averages again. And that might be one catalyst. If everyone's thinking, hey, yields are rolling back over again, we're getting closer and closer to that rate cut. If all of a sudden the 10-year treasury yield were to move back up toward that 430 level, and maybe on top of that, have a Fed official or two come out and talk about, well, maybe these interest rate cuts are going to get pushed, somewhere down the road, something like that might be a catalyst to spook the market and see some of those growth stocks sell off a bit more. Again, I'm just grasping for straws like most bears have been doing for the last year and a half. But hey, again, with the short-term issues that we have, I'm just waiting to see maybe if there's a catalyst that helps the selling begin to pick up a little bit. So far, not much. S&P 500. Just looking at the chart again. I mean, we looked at it, but here's your breakout back above that 5150, 5155 area. Closing yesterday at 5175, the highest close in history. Intraday didn't quite reach the all-time high. So if we look at a 5-day chart, and by the way, that reversal was on Monday. Or excuse me, no, it was on Friday. That was the big reversal right there on Mondays or on Friday. And then we had Monday, a little bit of recovery, and there's Tuesday coming right back up. But we haven't cleared the 5190 level, which was the high back on Friday of last week before we got all the selling. So maybe that's the number to keep a close eye on. Do we actually get that breakout? Do we hit the 5200? I mean, I really thought the first quarter, I was expecting the market to do pretty well, be a little choppy, and maybe get to 5100. That's what I said back in January. We've gone a little higher than I expected. Again, bull market, hard to bet against a bull market. I wasn't really betting against it, but maybe I was under, just maybe, I don't know, underappreciating the market and how strong it was. But anyway, right now we're up near 5,200. I would like to see us consolidate here, maybe pull back to about 5,000 or even spook the market a little bit, getting back into the 4,900s. It would be about 4% to take us down there. We'll have to wait to see if that actually plays out. NASDAQ 100, same deal, moving up, not getting quite the breakout that we saw back at the beginning of March and again late last week. But as we move back up, there's that PPO that just keeps moving lower and lower. Each time we go higher and higher, the PPO puts in a lower high. So we've got this negative divergence. I think it would be easy just for that to play out then to 17.5. I mean, we're just talking about what, 700 points? Again, maybe 4%. That's not a lot. Small caps, there was the reversal on small caps after we got up over 210, came all the way back down to the low 203s, down near that 20-day moving average. There might be a little bit more downside in the IWM, but this one I like better than both the QQQ and the SPY, which track the NASDAQ 100 and the S&P 500 respectively. I just think this area of the market, this asset class, is trading better, has a bullish cup with handle breakout in play right now. Mid caps looking even better than the small caps. And I think that's going to be maybe a little bit of a safe haven if, again, we see the sell-off coming in the QQQ. We'll see. Transports. So transports were up yesterday. We got up 0.6%. Trying to get above the recent congestion highs. I mean, we've been in this 15.4 to 16,000 area for the last month right here. We moved up yesterday, got to close at 15,882. Can we get a close back above 16,000? If we do, that I think would point us back toward the highs near 16.2. And maybe begin sort of an uptrend in transports, although I'd be careful until we get that breakout. But again, it improved yesterday. So we got different areas of the market telling us different things. But I do like the consolidation after an uptrend. I mean, here we had an uptrend. There was no consolidation. We went right back down. Here we went up and we're holding our gains. That in and of itself is much more bullish. The other thing we saw yesterday is with this move to the upside, look at the volume down at the bottom. Volume bar jumps. So it was about twice the volume we saw the day before, and with a strong finish. So transport's looking a little bit better. Moving on, chart of the day. For those of you who are new to earnings beats, maybe enjoy our look at the market. Maybe you're enjoying the show. There are a couple different ways to follow us. Number one, obviously, we'd love to have you join our paid service. We have a 30-day free trial. That's a long time to pay nothing and check our service out, kick the tires, see if we set up good, or at least in the same. Maybe we have similar strategies. Maybe we offer something that you don't look at currently. Maybe there's a little marriage there that makes a lot of sense to maybe ground you. Anyway, you can check us out with a 30-day trial. If you scroll down, there's an opportunity to sign up for our free newsletter. No credit card. 3 times a week it comes out. Name and email address is all it takes. I like to focus on things that are important to us. So a lot of times I look at earnings and the gaps created from earnings, the gap support. I look at relative strength. That's huge. Price volume, of course, but relative strength. Looking more for leaders in leading groups or leading sectors, leading stocks and leading industry groups in leading sectors. I mean, if I could get, everything lined up, if you have the best stock in the best industry group in the best sector, chances are you're going to outperform the S&P 500. And so that's what we constantly strive for, and keep watching the market, all this rotation taking place, trying to continually pinpoint those strong stocks, those relatively strong stocks. So what's the chart of the day for today? Well, we're going to go with BHC. First of all, here's your AD line. AD line was soaring during the month of February. We've seen a little bit of a pullback here in March as we've seen price pull back. But I want to annotate a couple of things on this chart. First, I think you need to be aware of where gap support was from earnings. There's the bottom of gap support. Notice when we gapped up, we've already pulled back and filled that gap. So we have filled the gap already. We don't need to go back down there. Now what we're doing short term is testing the rising 20-day moving average. So I think BHC looks good. The other thing that's interesting about this stock is that it's part of the pharma group, which tends to be a defensive group. So if you want to trade, but you're nervous about these stocks that are sky high, that have just been, unrelenting in their pursuit of, I don't even know what they're pursuing. These stocks are going up so much and so fast. But if it scares you to get into stocks like that, and we're in a period where defensive stocks tend to perform better, why not a pullback on a stock that's down near a support level? Also, BHC is about a $3.2 or $3.3 billion market cap company, which is a small cap. And if money is rotating toward, more value-oriented stocks and more small caps, even if it's in the short term, BHC, after this recent pullback to the 20-day moving average, could present an opportunity. Maybe it's an opportunity for 5% return. Maybe, you like to see 10, 15, 20% gains on your swing trades. Maybe this one's a little bit less. But hey, if the market does pull back and you can make money at the same time in a couple of more defensive names, why not? So it's just out there. I'm not a registered investment advisor. Earnings Beats is not a registered investment advisor. We don't have any registered investment advisors at Earnings Beats. So we're clearly not licensed to provide recommendations. And so that's not what I'm doing here. What I'm simply doing is telling you all the different reasons, hopefully providing some education in terms of stocks that could perform well in a market that is a little iffy. Now, if you want to take the position, obviously the risk is all yours, but this is what we put out there 3 times a week. Stocks, sometimes it's industry groups, sometimes it's things like sentiment that are helping drive prices in one direction or the other. All those things are things that we could include in our Earnings Beats Digest newsletter. So check that out and make sure you sign up if you haven't already. Okay, so we got about 5 minutes left, 6 minutes left. What are these things that I'm seeing? What makes me a little nervous about this market? And remember, beyond what I'm about to talk about, I could not tell you how bullish I am over the balance of 2024 and into 25 and probably 2026. I don't think this bull market is anywhere near being done. Let me really be clear about that. So what I am talking about here is a very short-term issue. We've got to get through these next few weeks. First, I want to show you, and I think I showed this yesterday, this is a 1-month performance chart of the various sectors. Now, if we go back and we look at the S&P 500, and let's go back and pull up that daily chart, this is where we were a month ago, and this is where we are now. Clearly, we've risen. Throughout almost every secular bull market, when prices are going up, you get leadership from those aggressive growth sectors. Technology, communication services, consumer discretionary, maybe to a lesser extent, financials and industrials. Many of those stocks are considered more value oriented, but you do have some that are more dependent on growth of earnings as opposed to dividend payouts and so forth. So there's still some components in both of those areas where we do see more aggressiveness, but really it's about XLK, XLY, XLC, those three groups. Now, when we go back and we look at this sector summary, what's leading this latest this latest secular bull market advance, the latest breakout on the S&P? And why isn't technology, or why isn't NASDAQ 100? Why isn't that broken out to a new high? The S&P 500 has. Look at leadership, materials, energy, industrials, real estate, financials, utilities, consumer staples. You're looking for technology, communication services, and discretionary. They're on the bottom. So materials up, and they're going higher though, by the way. That's the thing that kind of gets masked, is that we're still talking about semiconductors doing really well and software and all these different areas that have been, that are still at or near highs. I'm not saying those groups have sold off. I'm just saying rotation. There's been rotation out of those key areas. They're not moving much. And a lot of that money is rotating into more defensive areas and more value-oriented areas. And so that's a little bit of a red flag. I mean, on the one hand, for the short term, I think it's a red flag. For the long term, I think it's great, because now all these other areas are turning more bullish. So it's going to be just a bullish party, in my opinion, going down the road. But short term, money is rotating out of these really aggressive areas. And I think we just need to be aware of that. Next, S&P 500. I want you to really pay attention over the last month to month and a half. S&P 500 going higher. Here are some of my sustainability ratios. QQQ, performance relative to the S&P 500, going down. Normally when the market goes up, we see it going up. When we had the market going down, normally this goes down. It stayed the course, which told me that that selling wasn't going to last. Well, now, we had the QQQ leading up until late January. Since then, we're seeing a little bit of rotation away from aggressive growth and into more value to lead the market. How about XLY versus XLP? We topped back in December. I wouldn't say it's horrible, but we haven't broken out to a new high. In other words, the sustainability ratios are not breaking out with the S&P. And it's just again, they're not really breaking down, but this is just telling me that I don't know if I can trust right now this breakout to the upside in the S&P. How about the IWF versus the IWD? This is large cap growth versus large cap value. We topped a month ago. And what about transports versus utilities? We topped about a month ago. So all of these sustainability ratios that I like to follow in the short term just aren't really following suit. It makes me a little nervous. How about seasonality? Large cap growth versus large cap value. If you go back down here, well, first of all, you can see the first month, second month, third month of the calendar. strong, little bit weaker, and then weak. Go into the April, not so much strong there, but then second month strong, we drop off in the third month. Next quarter, strong, weakening, weak, strong, both kind of weak in terms of growth versus value. Because that's when we see a lot. November, December are very bullish months, but they both tend to be led both months by more value-oriented stocks. So here we are in March. If you add the gains, the relative gains, the relative outperformance of growth versus value, the third calendar month of each quarter, March, June, September, and December, it's flat. This goes back since the beginning of the secular bull market in 2013. This is not where growth outperforms in total. Third month of a quarter. Second month, yes. February, May, August, November, add those up. I mean, it's 2.8, 3.2% outperformance. The first month, 1 minus 0.1, so that's 0.9 positive. Add 1.7, 2.6. Add 0.1, that's 2.7. So you got 2.7 here, November 3.2, the second month of each quarter, I think was 3.2. And December, along with September, June, and March, flat. This isn't the month for growth. So seasonality lines up against us right now. How about this? This is my intraday. Let me make the width a lot wider here. Let's just go out to say 1400. Or no, that's height. Let me go back down to like 750. All right, so this is a intraday chart that I keep by using the user-defined index. So here is the chart that we looked at just a little bit ago. The overall trend in the QQQ versus spider is going up, but we have in the last month and a half been going lower. But even bigger than that is what's happened intraday. If we ignore gaps, we've broken down to the lowest level we've seen since back in really the beginning of November. So money is rotating during the day away from the QQQ and into the spider. Is this something to be worried about? Well, I wouldn't be talking about it if I didn't think it was something to be worried about. Again, I like to keep it real. I don't just cheerlead. If I start seeing signals that tell me be careful, then I talk about it. How about election year cycle? This is what election years typically look like, going back since 1950. So it's every fourth year. 1952, 56, 60, 64, 68, 72. I put all the years together, averaged them out, smoothed them, and this is the way they tend to go. Look at the big weakness that we see in March. So we're usually good until the first week of March, and then we drop. We're seeing rotation, but we haven't seen that drop yet. Once we get past March, most of the year is pretty good until a couple months right before the election. And that's what we want to be watching out for. Last one, just looking at the spider and Max Pain. So this is what we talked about with our members last night in Max Pain. Right now, the spider is at closed yesterday at 516.78. You know that Max Pain, this is the level at which all the in-the-money calls and all the in-the-money puts for the monthly option expiration, March monthly options. This is the level at which they offset one another. This is roughly the level where market makers would pay out the least amount of money in terms of March options. Now, do I think we're going to drop from 516 down to 477.25 over the next 2 days or even into early next week? No. That would be, could it happen? Sure. Maybe if interest rates all of a sudden take off, what about a couple Fed officials come out and say, that inflation report we saw yesterday is going to delay us in lowering rates? I don't know. Something could happen. Anyway, instead of looking at it as though we're going to go all the way down there, what I look at it as is a directional clue. Any movement in the S&P 500 lower than where we are right now saves market makers money. Now, it doesn't mean we can't go higher, because market makers, when they're selling, if everybody's buying calls on the way up and market makers are selling calls, you'd think they get killed if prices keep going higher, right? But if they take a covered call strategy, which is what I believe they should do, they would sell the call and turn around and buy the stock. So if prices keep going up, they're not going to get hit because they own the stock. But what if they sold the stock, ended up jumping on the short side, and drove prices lower in the near term? They would have profited from their long positions. They would then start profiting from their short positions as prices drop, and they'd pay out less money in options. Win, 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 windfall. That's what I call it. So I don't know if that's going to happen, but it's a risk. I went over last night, and I believe, and I've been looking at this for a long time, I believe there is more in the money call premium right now for March of 2024 than I've seen on any month previously. If it's not the highest, it's right up there near it. There is a ton of optimism short term with the options. And that's something that should worry you as you move toward option expiration. Anyhow, let's check and just see what the market's doing. It opened about 5 minutes ago. We got the Dow up a little bit, 53. We got the S&P down. We got the NASDAQ down a little bit more, down about 0.25%. Not really anything. Small caps, mid caps leading again today. It's been unbelievable. VIX still stubbornly staying up closer to 14. You know, we were down in the 12s. And here's the S&P setting new highs. And why are we still up a little bit? Why aren't we back down in the 12s? That might be another chart we could kind of throw in there. I'm still bullish. I mean, the VIX at 13, 14, 15 is still fine. Don't get me wrong. But we're not moving the new lows. So little maybe crack in the foundation, crack in the VIX foundation. Anyway, that's it for me. Listen, we've got a live trading room coming up in 23 minutes. Anybody who is a member at Earnings Beats can come join us, including 30-day trials, the free trials. So go back over to earningsbeats.com, sign up, start your 30-day trial right now, and join me in 23 minutes as I go through a lot of our chart lists, looking for the potential of perhaps some stocks, maybe not to buy today. You got to do your homework. Look for some stocks that you might be interested in. If this selling materializes, be ready. Be ready for it. So we're going to be talking a little bit about that during the live trading session in just a bit. So hopefully I will see you there. For everybody else, again, hit that like button, subscribe to our channel. That can help us. It's not just about joining. I mean, obviously joining helps us financially, but if you just like the video and subscribe, it'll help build our presence here on YouTube. And that helps us as well. Anyway, have a great day, everybody. Happy trading, and hopefully see you in about 20 minutes.